This is Matthew Cratter from Bitcoin University, and today I wanted to talk about how the Fed, the Federal Reserve, which is the central bank in the US, just went bankrupt. This is a follow-up to Friday's video in which I talked about a similar thing happening to the Swedish central bank, which is called the Sveriges Riksbank. It has also gone bankrupt and is needed to go to the Swedish government to ask for a bailout. But the same thing has happened to the Fed, as we're going to see. Now, in order to understand this, we have to understand how ordinary banks work. In the US, these are called commercial banks. Bank of America, Wells Fargo, JP Morgan, etc. are some of the very big banks. And the way banks work, like any other corporation or any other household balance sheet, they have assets, which is what the bank owns. And these assets may include cash, mortgages, business loans, auto loans. So when you borrow money from the bank, it's a liability to you, but it's an asset to the bank. And that's why you have to send them a mortgage payment or a car payment every month. So that's the asset side of the bank balance sheet. It's what the bank owns: cash, mortgages, business loans, auto loans, personal loans, things like this. The other side of the balance sheet is what the bank owes, in other words, liabilities. These include all the customer deposits. Basically, when you deposit money at a bank, you are making a loan to the bank and you have the right to receive that money back. Now, if you live in Lebanon or Turkey or Argentina or Venezuela, you may not get your money back, but it is one of the bank's liabilities. All these customer deposits, which includes checking accounts, savings accounts, CDs, and other ways that you can lend money to the bank. Now, the way we calculate equity in a bank, or shareholder value or shareholder equity, there are many different names for this, and we can have this in different corporations as well, but you simply subtract liabilities from assets. Assets minus liabilities would be the equity. If it's an individual, this would be your net worth. For example, if you're a person and your liabilities exceed your assets, in other words, you owe more money than you own, you are basically bankrupt and you have a negative net worth. And this can happen to corporations. It can happen to banks as well. The same is true for a commercial bank. If a bank's liabilities exceed its assets, it will need a bailout. And in fact, a bank run at that point has probably already started, and the bank can see its customers running out the door. So that's commercial banks. Now let's take a look at how a central bank works. A central bank is really just the bank for the commercial banks in a country. As we said, the Fed, the Federal Reserve, is a central bank in the US. I'm going to be using government data from the Federal Reserve itself, and I'm going to show you how to get this data so that you can check on this in the future. I will link to this press release page from the Fed, and we can see here that they make approximately 4 or 5 releases, their weekly releases. We're going to be looking at the October 26th, 2023 data, so it's fairly recent data. And if we scroll down to number 5 on that link, we can see the consolidated statement of condition of all federal banks. So this is adding up all the regional banks and looking at what their assets and liabilities look like. So at the top we have the assets, and we have the list of assets as of Wednesday, October 25th. If we scroll down, we can see we have liabilities. And then they call the final line capital, and you get that just by doing the same subtraction that we did before. Assets minus liabilities equals total capital or equals total equity. If we draw data from this page, we can see that the Federal Reserve's total assets are approximately 7.9 trillion. Its total liabilities are 7.865 trillion. And so it has equity or capital or positive equity or tangible equity, whatever you want to call it, assets minus liabilities. It's $42.7 billion. So the Fed appears to have positive equity. But now let's take a closer look, and we're going to see what's really going on. If we take a closer look at the asset side of the Fed's balance sheet, we can see right here there's a line item called gold certificate accounts that holds approximately $11 billion worth of capital. We can see here for all these calculations, this is measured in millions of dollars. So you basically have to add 6 zeros to that, which takes you to 11 billion. So these are gold certificates, and they're a very strange thing because this is based on something that happened back in 1934. We've talked about this many times, when the federal government stole gold from all the US people, and it also stole it from the Fed as well. And what it did is it stole all of the physical gold that was being held by the Federal Reserve, and in return, the U.S. Treasury gave the Fed paper IOUs, saying, I owe you this amount of gold. Now, the strange thing, though, is those paper IOUs were written to be non-redeemable, meaning that the Fed can never get its gold back from the U.S. Treasury, and that's assuming that the gold is still sitting there in Treasury accounts at Fort Knox and it hasn't been stolen or sold off already, which is, of course, a possibility. So that $11 billion worth of gold is actually a fake asset on the Fed's balance sheet. It's just paper that can never be redeemed. But wait, there's actually even more on the balance sheet we're going to talk about. But before I do that, if you're finding this video helpful so far, I just ask you to hit the subscribe button. That really helps this channel's reach and my educational mission. Also hit the like button, hit the comment button, leave a question or topic for a future video, and also share this video with a couple friends if you can. That would really help out the channel a lot. So if we are approaching this as an accountant or as an analyst, we would want to subtract out this $11 billion worth of assets because it is fake. It's paper assets that can never be redeemed. But it's even worse than that. So now we're going to look at the liability side of their balance sheet. We were just up here looking at the asset side. We're going to scroll down and look at the liabilities. And the first thing that really catches your eye is they're all positive numbers here, but you have a negative number right here, which actually serves to reduce the total amount of liability. So if this were a positive number, this total liabilities number would be larger. Because it's a negative number, this number is smaller. So it's a way of basically reducing the Fed's liabilities. And when you have a negative liability, it actually can be counted as an asset, as we're going to see. So if we scroll down, we ask ourselves, what are these other liabilities? If we scroll down, there's footnote number 15 here, and we can see that this includes the liability for earnings remittances due to the U.S. Treasury. If we scroll down further on the page, we can find the actual number for that, which they don't break out, and that's right here under the statement of condition of each Federal Reserve Bank. We have all the big local Federal Reserve branches, Boston, New York, Philadelphia, etc. And right here is the total column that sums it up. And we can see here that earnings remittances due to the U.S. Treasury is a negative liability as well of $113 billion. Again, this is denominated in millions of dollars. I'm convinced that the Fed makes this very difficult to follow on purpose. But what's happening here is you have this huge negative liability here that feeds into this number right here, and it's sort of buried on the main balance sheet because of this. So then the question becomes, what are earnings remittances due to the U.S. Treasury? And so we need to rewind a little bit to understand this. The background is this: for many good reasons, you want your central bank to be independent from the federal government. If it's not, the federal government can just order it to juice the economy right before an election, juice the economy, or we're going to slash the central bank's operating budget. And the only thing worse than an independent central bank is a central bank that is beholden to the executive or legislative branches of the federal government. That's really how you get very high inflation or hyperinflation very quickly. So the Fed was set up to be self-funding, and the way it funds itself, it's not relying on the federal government for its budget, for its operating budget. The way it funds itself is the Fed earns interest on the assets that it owns, which at this point are mostly U.S. government bonds, which are called U.S. Treasuries, as well as mortgage-backed securities, MBSs, which are packages of mortgages. And if you have a mortgage, it's probably sitting somewhere inside of an MBS. So the Fed earns interest on the assets that it owns. The Fed also pays out interest to the commercial banks and the money market funds that hold some of their money with the Fed in the form of bank reserves and what you may have heard called reverse repos. So in normal times, the Fed is earning more in interest than it's paying out. And this is the Fed's earnings. It earns some interest on the assets it owns. It pays out interest to the commercial banks and money market funds, and it makes a profit. And that is the Fed's earnings. And then these earnings are used to pay the Fed's operating budget, salaries, electricity for the money printers, etc. These earnings are also used to pay a dividend to the commercial banks who are technically shareholders in the Fed. I believe this is a rather small dividend. And then the bulk of the money actually gets paid back to the U.S. Treasury. By law, any excess profits are required to be paid by the Fed back into the U.S. Treasury. And so this helps to fund the U.S. government's, the federal government's operating budget. Over the past decade, this has averaged about $100 billion per year. So it's a large amount of money. And this was some nice extra spending money that the federal government could use for its many worthless and bureaucratic and violent projects. But then something changed in the last couple of years. What happened is the Fed hiked interest rates so quickly that it blew itself up, just like the Swedish central bank did, as we talked about in last Friday's video. By hiking interest rates, the Fed tanked the value of the assets that it's holding on its balance sheet. When interest rates go up, the price of bonds like mortgage-backed securities and U.S. Treasuries goes down, so the asset value declines. Also, by hiking rates, the Fed also increased the amount of interest that it needs to pay the commercial banks and the money markets that are parking money with the Fed. And so what's happening today is the Fed is paying out more in interest to these banks and money markets than it is receiving interest from the assets that it holds, those treasuries, those government bonds, and those mortgage-backed securities. So now every year the Fed is actually losing money. It's a money-losing bank. But the Fed is not like you and me, or even a regular bank. Fortunately for the Fed, it gets to make up its own accounting rules, and here's how that works. As we discussed before, the Fed normally owes excess profits, excess earnings to the U.S. Treasury, and this has averaged about $100 billion per year. But today the Fed has no profits. It has no net positive earnings because it's paying out more money than it's receiving. There is a rule that says that the Fed does not need to pay any money to the U.S. Treasury out of its earnings until it has recouped all of its operating losses or all of its investment losses. So if the Fed loses $100 billion in 2023, it will not have to pay back any excess profits to the U.S. Treasury until it recoups or makes back that $100 billion. And now, thanks to the magic of central banker accounting, that $100 billion becomes what's called a deferred asset that the Fed can park on the asset side of the Fed's balance sheet. The opposite of a liability, in other words, a negative liability, becomes an asset and it gets moved over to the asset side of the Fed's balance sheet. And what's weird about this is the more money that the Fed loses, the more its asset value actually goes up because it gets to add more and more deferred assets to the asset side of the balance sheet. Must be nice. So now we understand earnings remittances due to the U.S. Treasury. If you're wondering how I know how the Federal Reserve works, is from their own footnote here, footnote number 8. The Federal Reserve banks remit residual net earnings to the U.S. Treasury after providing for the cost of operations, payment of dividends to the other commercial banks, and the amount necessary to maintain each Federal Reserve bank's allotted surplus cap. Positive amounts represent the estimated weekly remittances due to the U.S. Treasury. Negative amounts represent the cumulative deferred asset, there's that word again, the cumulative deferred asset position, which is incurred during a period when the earnings are not sufficient to provide for the cost of operations, payment of dividends, and maintaining the surplus. The deferred asset is the amount of net earnings that the Federal Reserve banks need to realize before remittances to the U.S. Treasury resume. So that's just confirming everything that we've talked about. So now we can go back here. We can see there's that negative item on the liability side of the Fed's balance sheet. And again, if we scroll down, we can see that that is what's contributing to that is these negative earnings remittances due to the U.S. Treasury, about approximately $113 billion right here. So now what we can do is we can make an analytical adjustment to the Fed's balance sheet. We previously calculated that they had net equity, assets minus liabilities of approximately $42.7 billion. So the Fed appeared to have positive equity, but now we need to take out that fake deferred asset. This is not a real asset. This is deferred money owed to the U.S. Treasury that it's not going to need to pay back until it recoups those losses. As we saw from the balance sheet, that's approximately $113 billion on the asset side of the Fed's balance sheet that is fake. And so if we subtract this from the Fed's total assets, we realize that the Fed now has negative equity. This has never happened before. This just took place a couple months ago in 2023. The Fed has net negative equity. In other words, it's bankrupt to the tune of $70.5 billion. And now if we subtract out those fake gold IOUs, which we talked about, which were approximately $11 billion, the Fed has net negative equity of 81.5, so nearly $82 billion. In other words, the Fed is insolvent. It's bankrupt according to its own balance sheet, its own government numbers. And if it were a regular corporation or bank, it would have already filed for bankruptcy or requested a bailout. But bankers are special people, fortunately. They go by one rule for me, another rule for thee. This is just like Congress. If you're in Congress, you can legally do insider trading. If you're a private individual, you go to jail for this. If you're in Congress, you don't have to have Obamacare, but you get your own special health plan. And if you're the Fed, you can blow yourself up and then just change the accounting rules to fool people. So what are the real world implications of this? One of the biggest implications is that the US government no longer gets that juicy $100 billion annual payment from the Fed, so it has just lost a major source of income. And to put this in perspective, $100 billion doesn't seem like a lot of money anymore. But if we look at the operating budgets of the Department of Commerce, it's $125 billion. Department of the Interior is $93 billion. Department of State, which is a very important department, $84 billion, etc. The EPA gets $84 billion. So $100 billion basically takes out a couple of these departments or agencies in the federal government. The other really weird thing is that the more money that the Fed loses every year, the more it can increase its deferred asset balance sheet line item, and that increases the Fed's total assets. The higher the Fed's total assets are, the more new money that it can create and slosh into the system, causing even more inflation, because that's the liability side of the Fed's balance sheet. Also, now that the federal government is no longer receiving that extra $100 billion from the Fed every year, the federal government, the U.S. Treasury, is going to need to issue an extra $100 billion in government debt every year, unless they cut spending, but the U.S. government never really cut spending. So that over a 10-year period, over a decade, that's another $1 trillion in debt that will need to be issued and serviced. And this is a problem because debt payments, interest payments on the national debt are already approaching $1 trillion. And we're now going to add another $1 trillion over the next 10 years to the federal debt because they're no longer getting this funny money from the Federal Reserve. Final question, which I saw in Friday's video as well: why can't the Fed, why can't the Swedish central bank, why can't any central bank just print money and bail themselves out? The problem is they're the top of the food chain. It's very hard to bail yourself out when you're at the top of the food chain and there's no one above you. And this is the problem, because when a central bank prints money, what it's actually doing is it's increasing the liability side of its balance sheet and thus giving itself even greater net equity, unless it also adds something to the asset side of the balance sheet. So if the Fed's going to print up more money and thus increase the liability side of its balance sheet, it's going to need to buy some more treasuries or mortgage-backed securities with that printed money and add it to the asset side of its balance sheet. Otherwise, it's going to get even greater negative net equity. But if the Fed is buying treasuries, that's actually quantitative easing, that's QE. And what they're trying to do instead is QT, which is quantitative tightening, selling off bonds rather than accumulating bonds. So this is the mess. This is a huge mess. It doesn't mean the Fed's going to go out of business and close their doors, because they basically can just keep going and they can play accounting tricks. But it does have real implications for the U.S. federal government's spending. The good news, though, is that you can opt out of this whole mess and own Bitcoin instead of US dollars or US treasuries. And I always laugh when I hear people say that Bitcoin's too confusing or too complicated, and so people will never invest in it. This meme says, please explain how the current global fiat monetary system works. People have no problems buying US treasuries or buying bank CDs, and they don't even understand that their money is not even being held by the bank, but is being lent out in waves of fractional reserve banking, as Satoshi said so well in his white paper. So if you don't like central banks operating when they're still bankrupt, you do have an option now. You can buy Bitcoin, you can hold your own private keys, and you can have sovereign wealth that cannot be debased by central bankers and that cannot be confiscated or frozen by bankers. If you enjoyed this video, be sure to hit that subscribe and like buttons. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.